Today I want to talk about this ZNGA call that I have in one of my trading accounts here. So this is a call, $8.50 for ZNGA. $8.50 is the strike. And you can see that this position has done pretty well for me. Current market value of the position is $174. The initial cost was $113. So that means I've made about $62, 54% on the trade, which is awesome. There's only 11 days left, so I love it. I'm really happy. I want to protect some of this money. With a long call, one of the biggest risks that I have is what's called expiration risk. So the fact that there's an expiration date on this call means that if ZNGA doesn't finish above 850, it's currently at 10 something. If it doesn't finish above my strike price, then all of this money is potentially lost. It's $176.50. So while these options offer this great opportunity for fast gains, 55%, 55.5%, it's phenomenal, you're exposing yourself to a lot of expiration risk here. So today I'm going to take some of that off of the table. So what I'm going to look at is buying a put to balance this out and make this into a spread. And that's going to take a lot of this 176 off of the table. And remember, we've got some profit to play with here. We've got $63 to use. So we go into trading. We go to our options chain. We've got the July 24th calls and puts. Here's my position. It's showing on the call side, the little green arrow showing that I have this position in place, and this is my bid and ask spread. So right somewhere in the middle is the market value, which is also synonymous with the amount of risk that I have on the table. So what I can do is I can buy a put. Let's say I want to buy a put to make this thing this position into a spread. For $2, I can buy a $9 put. That means I will buy at $8.50 and sell at $9, which means that I'll get at least $50 back. But that's sort of locking in a little bit of a loss because I paid $113 initially for the position. Plus 2 means I have $115 invested in the position, and I'll only get back $50. So that's a great start. That's taking a lot of risk off the table, $50 worth. Oh, and look, now it's only a penny. The thing is that it's still going to expose me to a $50 loss, in fact, it would be 113 plus a penny, so 114. So it's going to be $64 loss potentially would be the worst that could happen, and I don't really like that. I'd like to take a little more risk off the table. So I'm going to look at this 9.5 put right here. Now if I buy this put, what happens is I'll sign at expiration, no matter where the price is, I'll be able to at least buy at $8.50 and sell at $9.50, protecting $100 out of the 174 that's currently at expiration, that is my expiration risk right now. So I like that idea of taking $100, a little less, off of the table in my expiration risk. It's very cheap. It's only going to put a $7 drag on my position. So I have an order here that I'm going to modify. I'm going to buy one put. I'm going to see if I can hit the bid for $7. And if I'm a little bit patient, my total invested in this position is going to be $113 plus 7, which is $120 altogether. And I know that I'm at least going to get back $100, meaning that I'm leaving only $20 of total risk on the table, much better than $174. And what's going to happen is that this thing still has a lot of time to move. So we still have 11 days to expiration, and I could make a lot of money if ZNGA keeps going up, or I could make a lot of money if ZNGA crashes. Either way, I know I'm going to get at least 100 of all that back of my total expiration risk. So I like that. It's not really a free position. I'm risking 20 bucks, but I've taken a lot off the table, and now we can just see what happens over the next 11 days. I don't really have to sweat it out. I doubt I'm going to adjust this. I bet I'm just going to see if we can get Zynga to run either really far to the upside or really far to the downside, and just see how much money this spread can make. So we'll check back in with it at expiration, but right now it's not a risk-free position, but it's close to it. If I wanted to go higher with the put price, I could lock in even all the way up to a potential profit. The higher I go, the more risk I take off the table, even to the point where up here it would be a guaranteed, the position would be a guaranteed profit. The only problem is Zynga would have a lot farther to go. It would have to go above $11.50 to make profit on the upside, and it would also have to go a lot further down to be able to make money on the downside. And so I'm looking at just taking most of the risk off the table, not too much. I want it to be close to a riskless position, but still give it a lot of chance to move in either direction and make a lot of money for it.